Have you ever wondered what really happens when you deposit money in a bank? Most people think it just sits there safely in their account, but banks are actually doing a lot more behind the scenes. From loans to investments, the ways banks make money from your money are constantly evolving, and technology is only speeding things up. In this video, I'm not just explaining the old school methods banks use to profit. I'll show you how modern banking, digital platforms, and emerging financial tools are changing the way your money works, and how banks might be finding even smarter ways to earn from deposits by 2030. Before we dive in, if you like getting a behind-the-scenes look at finance and understanding how your money really works, hit that like button, subscribe, and turn on the bell so you never miss my insights. Lending out your deposits. Here's the thing most people don't realize. When you deposit money in your bank account, that money doesn't just sit there in a vault with your name on it. Banks are legally allowed to lend out most of your deposits to other customers. Let's say you deposit $10,000. The bank might keep only $1,000 in reserve and lend out the remaining $9,000 to someone buying a car or a house. Now here's where it gets interesting. You deposited that money for free, or maybe you're earning 0.5% interest. But the bank is lending that same money out at 5, 6, or even 15% interest, depending on the loan type. That difference between what they pay you and what they charge borrowers is called the interest rate spread, and it's their biggest money maker. Think about it like this. If a bank pays you $50 a year on your $10,000 deposit, but charges a borrower $600 in interest on that same money, they're pocketing $550 in pure profit. Multiply that across millions of customers and billions of dollars, and you start to see why banks have those fancy buildings downtown. Charging fees for everything. Banks have mastered the art of nickeling and diming their customers. Overdraft fees are probably the most notorious. You accidentally spend $5 more than what's in your account, and boom, you get hit with a $35 fee. That's a 700% markup on a tiny mistake. But it doesn't stop there. Monthly maintenance fees, ATM fees when you use another bank's machine, wire transfer fees, paper statement fees, minimum balance fees, you name it. Some banks even charge you for talking to a human teller too many times in a month. Here's what makes this so profitable for banks. These fees cost them almost nothing to implement. It's all automated through their computer systems, but they generate billions of dollars every year. In fact, some of the biggest banks make more money from fees than they do from interest on loans. The beauty of it from their perspective is that once you're locked into their system with your direct deposit and automatic payments set up, switching banks feels like a huge hassle. So most people just accept the fees as a cost of doing business, and the banks keep cashing in. Investing your money. Your deposits don't just fund loans to regular people. Banks also use your money to make investments in stocks, bonds, real estate, and other financial instruments. They have entire investment divisions staffed with professional traders and analysts. These folks are using pooled customer deposits to play the markets and hopefully generate returns. When these investments pay off, the bank keeps the profits. When they don't, well, that's where things get interesting because of something called FDIC insurance. Your deposits up to $250,000 are insured by the federal government. So even if the bank makes terrible investment decisions, you're protected. The bank gets to take risks with your money knowing that if things go south, the government backstop is there. Meanwhile, when their investments succeed, they keep every penny of profit beyond what they owe you in interest. It's essentially a heads they win, tails you don't lose scenario. Banks invest in government securities, corporate bonds, mortgage-backed securities, and all sorts of complex financial products. Some of these investments are relatively safe, others are riskier. But the potential returns are much higher than what they're paying you on your savings account. Credit card interest and fees. Credit cards are absolute gold mines for banks. The average credit card interest rate hovers around 20%, with some cards charging even more. If you carry a balance of $5,000 and only make minimum payments, you could end up paying thousands in interest over time. But here's what most people don't realize. When you swipe your credit card at a store, the merchant pays the bank a fee, usually around 2 to 3% of your purchase. So if you buy a $100 item, the merchant only gets $97 or $98. That missing $2 or $3 goes to the credit card company. Now multiply that across billions of transactions happening every single day. It adds up incredibly fast. And if you miss a payment or pay late, there's another fee stacked on top. Banks love credit cards because they generate revenue from multiple streams simultaneously. Interest from people carrying balances, transaction fees from merchants, annual fees from cardholders, late payment fees, foreign transaction fees, balance transfer fees. The list goes on. Plus, the risk is relatively manageable because they can spread it across millions of cardholders. Sure, some people default on their credit cards, but the profits from everyone else more than make up for those losses. Wealth management and advisory services. Once you have a decent amount of money in the bank, they start offering you wealth management services. They'll assign you a financial advisor who'll recommend investment products, retirement accounts, insurance policies, and estate planning services. Sounds helpful, right? Here's the catch. Many of these advisors are essentially salespeople working on commission. They get paid when you buy the products they recommend. So that mutual fund they're pushing might have high management fees, a portion of which goes back to the bank. Those insurance products often have hefty commissions built in. The investment portfolios they construct might favor funds that pay the bank more, even if there are better options available. Don't get me wrong, some bank advisors genuinely want to help you. But the system is designed so that the bank profits from almost every financial product they sell you. They might charge you an annual advisory fee of 1% of your assets under management. If you have $1 million invested, that's $10,000 a year going to the bank just for managing your money. And that's on top of the fees embedded in the actual investments themselves. Fractional reserve banking magic. This is where things get really mind-bending. Banks don't actually need to have all your money on hand. They operate on what's called a fractional reserve system. The Federal Reserve requires banks to keep only a small percentage of deposits as reserves. For most banks, this reserve requirement is around 10%. So here's the crazy part. When you deposit $1,000, the bank keeps $100 in reserve and can lend out $900. But when someone borrows that $900 in deposits in their account, the bank can now lend out 90% of that, which is $810. And when that gets deposited somewhere, they can lend out 90% again. This cycle continues, and through this process, your initial $1,000 deposit can theoretically create $9,000 or more in the overall money supply. The bank is collecting interest on all these loans that stem from your original deposit, making money from your personal data. In today's digital age, banks have accesses to incredibly detailed information about your financial life. Every transaction you make tells them something about your habits, preferences, and lifestyle. They know where you shop, what you buy, how much you earn, and how you spend. This data is valuable, really valuable. Banks use this information to target you with specific products and services. If they see you're spending a lot on travel, they might push a travel rewards credit card. If you're making regular payments to a landlord, they know you might be in the market for a mortgage. But it goes beyond just internal marketing. Banks can also aggregate and anonymize customer data to sell insights to third parties. Retailers, advertisers, and other companies pay good money for information about consumer spending patterns. While your specific information isn't sold, the collective data from thousands or millions of customers creates valuable market intelligence. When you think about it, banks making money from your deposits isn't just about fees or interest rates. It's about systems, strategy, and trust. The tools and methods may evolve, but the core idea stays the same. Your money in the right hands can work in ways you might not even notice. I'm curious, now that you know a bit more about how banks profit, does it change the way you think about where to keep your money? Share your thoughts in the comments. I always enjoy reading them. If this video gave you a clearer picture of the banking world and how your money is used, don't forget to like, subscribe, and share it with someone who might find this eye-opening. Thanks for watching, and I'll see you in the next one.